All right, guys, we're going to make this quick because it's August 25th, 2015, and if you're watching on recording, you should know that's about the time that China hit this market with a great deal of volatility and their weakness. And there's some things that I quickly want to go over that you might have heard me say a lot in the past, but it's worth going over. But then it's also worth having this on record so you could go back and always refer back to trading volatility and some really important bullet points when you're going through it. Things you've heard me say, price of poker has gone up. You're in Las Vegas and there's a minimum bet at the tables. On the weekends, those minimum bets go up. Guess what? More reward, but much more risk. So if you're not willing to take the risk, you have no choice. These markets are moving at some point, it becomes a bloodbath, right? It only takes one small idea to get long or get short and be wrong and not be able to get out, start adding to a position, and now all of a sudden that little idea became a monster, giant hole in your trading account, crippling your emotional capital and everything else. All it takes is one little idea if you're the type of guy who can't get out of losing trades. Said this before, multiple contract traders have to cut their size. I'm going to cover that in a second in the slide. This is like a prop group. You guys have been, around that. They go into the team room, great. You come out of there, we're in a conference room. Visualize that, be a short meeting because these markets are moving. We don't want to miss anything. So trading volatility, what's important about it? Let's go through, not that. These are all the other slides. Let's go through this first slide of bullet points. Number one, find a leader. And I don't mean a person, I mean another market. It could be the yen. At times, his risk aversion is opposite. Sometimes it's the bonds. However, in this latest bout of volatility with China, it has not been the bonds yet. It's been the yen a little bit, but find a leader. Could be the NASDAQ leading the S&P, the DAX leading the S&P, the ES leading the DAX. Something. Find it and share it with the community. If you're not sharing, first of all, no one's going to share back with you. And I learned that from the prop owner I used to work for. He would talk to other prop owners, and he came to the realization that you can't keep everything a secret of what you're doing, or they're not going to share. You got to share a little bit. Well, you're not going to give up an edge and give up a secret by telling someone, hey, this market's leading us. Because it's not, first of all, going to lead forever, right? And then when they find something leading, they'll tell you. And you could make your day, your week, your month just on that little bit of information. That's the important part of a prop firm and that recreation of that virtual environment. Find a leader. Secondly, market orders to get in and get out are usually going to be the order type of choice. I'll show you that when we wrap things up at the end. These last three, short leash, use time. Time is your friend. If it's not going your way, it probably won't. Don't get greedy. Take profits, short leash on shorts, short leash on longs. It's really hard to build a bias and keep it when the damn market doesn't keep their bias. Why would you keep your bias when the market doesn't keep its bias? It was bullish to 42. It got transitionally weak around 38 or wherever where it came down when we ended the trading room, and then it got weak. It changes its mind. You better. If you're not changing your mind, then you're not a trader. Go be a chemist. Cut your size. If you trade one lot, you might have to sit on the sideline. I often say those on the sideline when it's volatile don't know what they're doing, but it also means that if your full size is one contract, you're not going to be able to take the same amount of risk that you did last week at this time. With one all in and all out with just one contract, you have no choice but maybe to sit back and watch because the price of poker's too high. You went to Vegas with $500 in your pocket, you probably can't sit at a $50 blackjack table. If you trade 6 contracts, for example, in the ES, cut it in half. You can build it back up. The market is not giving you a choice. It's increasing your risk, so you have to manage it. And you manage it by reducing your size if you can. If you can't, you're in a roller coaster with no seatbelts, no bars across your lap. All you got is your arms, your ability to stay in it. Forget about your hat. Your hat blows off, don't chase it. Just don't lose your head. When you lay limit bids to get long or limit offers to get short, you better be careful. I'll give you an example of that when I pull over a dome. You could be on the railroad tracks and the train run right through you, and you actually could be right. You could get long at a good spot, but take too much heat, get out, then it goes. There's a lot more slippage when there's a lot less volatility at each price. Just know that. When you lay limit bids or limit offers to get long or short, you could be on the tracks and get run over. Don't be surprised. Be very careful, whether you get in with market orders or limit orders. But especially if you're just sitting there on the tracks, train doesn't stop, runs right through you, could be some event came out. What to watch for? What to watch for? Know the story. If you don't know the story, then you're not a pro. You stink. Right now, the story is China. Everybody should know that. They should have known that 2 weeks ago when they came in and devalued the yuan like 2.5 weeks ago. Their markets were underwater. They revalue, they devalue, and then wham, they came up, and then bam, they got whacked again. That was the story over the last 2 weeks. Now, we didn't have volatility over the last 2 weeks. It just started last Thursday when everything China's government and central bank was doing wasn't working. Then it just started spreading quickly, and it became a meltdown Thursday, Friday, especially Monday, August 24th. The Dow was down. The cash Dow was down over 1,200 points, closed down 600. We were down over 140 handles, 140 points. We were limit down twice, 2 circuit breakers in the NASDAQ, 2 circuit breakers in the S&P. They rallied like crazy, though, over 100 points out of the hole in the S&P one day, few hours. The next day, which is today, comes in and we've got a 70-point better open. We open up 3.5% better. We can't rally, we break, we can't break too much, we come back. We're right in the middle of today's regular trading session low and today's open. We're pretty much right in the middle of it. Again, the market right at this point probably doesn't know what it wants to do, so don't try to overanalyze and figure it out too much. So know the story. It's China. And don't read all this stuff. Let me walk through it. First bullet point, what will be bearish or bullish based on what they could do? Know what a surprise is, know what's baked in, know what is something that's an outlier. They did some repo injections. You don't have to know much about what that means. All you got to know is that they made some capital infusions in the market yesterday, and it really didn't help. It helped a lot of the other Pacific Rim countries and Greater Asia, but not China and Shanghai specifically. They were still down 5-7%. They could ease monetary policy along with those capital injections. Their prime rate's like at 4%, 4.5%. Ours is at 0. We can't lower it anymore, right? We had to introduce quantitative easing in November 2008 in order to have cheaper money. They could. They got some wiggle room. They haven't done it yet. They're really kind of like don't know what to do, and there's what's hitting the fan. Will this create our Federal Reserve or the Bank of England, 2 central banks, in hawkish mode, in tightening monetary policy mode? Will it force them to lay back? Raise rates later rather than sooner would initially be bullish for stocks. Take a look at the yield curve. Take a look at the short end. We'll have Woj on next week, I think, to talk about that and the chances of pushing a rate rise. Forget about September, forget about December this year, but maybe March of 16. First story I read about that was last night. That could be possible. So know the story. China ETF could be a good leader. FXI is one to watch. Share with other people. You find a good leader in a good way. You wake up in the morning, you should automatically know what China did. You should know what China is doing and open, because they open about 7 o'clock Central Time. I fell asleep watching Bloomberg about China and what was going on, how they opened, and how all the other, Singapore and Japan and everybody was opening up and pretty strong, had a nice balance. Our futures had a nice balance here in the U.S., but China was struggling a little bit. And a little bit of what they were doing, what those capital injections meant. The fact that they have some room to ease monetary policy. The fact that their prime rate is above 4%. So know the story, share info. If it's a link to a news article you read that was short that's applicable to what we do, share it. People will share back. In the team room, they have a nice way to share it. That's probably your best point of contact with each other is that team room. Do not, and in capital letters, be surprised. If you are, you stink. You're surprised that we go and make higher highs through 1950 of yesterday and we go to Friday's close. You're not prepared. If you're surprised that we break and go through, yesterday's close of 1871, you stink. You can't be surprised. If you're surprised, if you're one of those people that get surprised a lot, you're not good. Would you want your doctor to be surprised a lot? Would you want your attorney, if you're on trial for your life, to be surprised a lot? Then why would you, as the manager of your trading account? Do not allow yourself to be surprised. Get the hell out. People who are surprised didn't believe that they could buy and get long that much and the market could still go lower. So do not be surprised. It's catastrophic and it's an eliminator when you come to trade in volatile markets. You might not get eliminated. You might not blow your trading account when it's a 5-point, 7-point range day in the middle of the summer or the middle of December when it's just really slow and the markets are just drifting around and allows you to take 2 points of heat and have it come back and all that rosy, comfort stuff. And then you could talk to guys in a forum and tell them what you're thinking and all that's great. You might not get your face ripped off. Not the case when it's volatile. All the nice things that are said you don't have time for any of that. The shark doesn't even you don't even see the shark. They just eat you and you're gone. So screw all the forum stuff that you talk to and people analyzing what the heck is going on and too much of an over analytical. Just forget about analyzing. React. If you're not reacting when it's volatile, you're really in trouble. You should be reacting when it's slow, let alone when it's volatile. But know what to watch for, share, know the story like a trader, not like an economist. If you start explaining to me what's going on with the economy like an economist, fine, but you know too much. Short-term stuff, because we're short-term traders. Who the hell cares what might happen in these markets in 3 months? Or will we be back up at the highs? Who cares? I could tell you we're going to be trading at a certain price and be dead right in 2 days. But unless you bought it and able to manage your risk and make money, it's useless. The mentor, the guy who got me into the business, made a great call yesterday, but he even prefaced and said, good luck trying to buy it, though. He said it was down 1,200 points in the Dow. He says, we'll probably close down 600. Dead right. We closed down 588 Monday. But he said even afterwards, he goes, it's fantasy land to think you're going to be able to even buy it down there. You just got to almost, you don't ever want to be lucky when you trade. But in volatile markets, sometimes if you can get a market or a price to go your way and say, hey, that was luck, great. Better to be lucky than good sometimes, but not all the time. What's really important is time. The market will tell you if you're in a good location because it'll go your way right away. It'll tell you you suck and you're in a bad location because it'll zip right through you. Listen to the market. Don't ignore what it's telling you. Right now we're starting to test some swing lows, I would imagine. I'm not even looking at a chart, and I think this is the test of some swing lows where we've been since we kind of transitioned lower at around 1025. What to watch for? It's really important. Share things that are interesting and leaders, and people will share back. All right, let me drag. I opened up Trader, this other machine, and let me drag it over here a second. This is important. You guys might not be able to see it. Yes, you could see the dome. Now you can't. Now you see it, now you don't. Hold on a second. All right, here's a dome, right? I'm going to put it on sim because I'm going to click around here and just, when I lift an offer to get long, okay, that's doing this. I'm long one. I'll try to scratch it. I can't. Remember, this is sim. So now I'm stuck. How am I going to get out? Am I going to offer it like this? I might get filled, or it might just be stuck. Now I'm really in trouble. You got to hit a bid to get out and be done with it. Lift an offer to get in, hit a bid to get out, and you got to be quick. That 1,000 lot came in. You can't do this. So here's 1,000 lot. He's been at 30 for a while. You leave a bid in here of like 6 contracts, let's just say, and it comes down and hits you. Watch what's going to happen when they hit this 30 even. You just got to be ready to get zipped right through. I wouldn't want to do this. I prefer to sell right through it. Not right up in here necessarily, but hit the bid as they're trading through it. Let's say I want to get short 30.75. I hit the bid and get short right there. That's usually going to be the order type of choice. Hitting a bid to get short, lifting an offer to get long. In momentum areas, this is kind of just choppy. If you hit a bid and it's doing this, I'm going to try to get out because it's not going to go. If it didn't go, it's not going to go. I got to get the heck out. You can't let 2 or 3 tick losers on whatever size you trade. You can't think about that as the money that it costs you or you're dead. You're just trading around, flipping around numbers, and then you check your P&L from time to time. Yes, this is it's got a automatic center, but I don't want to turn this into a tech session. But you can, if you go through preferences, you could auto center this, or you could click it down in here. They come down in here, and it's been a good support. Dave mentions in the chat here all morning. If I wanted to buy these 32.75s, I bid them. Take a 1-tick winner, I get out. What did I do? I hit a bid to get out. I lifted an offer to get in. This is on sim, by the way. I don't think I'd want to even trade down in here, not knowing what's going on. But let's say I wanted to get short 33.50s, and it went bid against me. And now I'm like, shoot, I got to get out. I just lift an offer to get out. And you could say, oh, you lost 3 or 4 ticks. That's not a lot that is a lot last week. And you really could be in danger if you're taking quick 3 or 4 tick losers. But last week wasn't volatile. 3 or 4 ticks is nothing. The damn bid and offer are more than 3 or 4 ticks wide. Even though they're a tick wide, you ain't getting out in a tick. If I buy these 34 evens or 34 quarters and I'm wrong, I'm long now, right? I'm wrong. I'm not going to get out for a break even or a -1. I got to reach probably down here is where I'm getting out. You could put a stop there, or you could just hang your arrow down there. Now, if I go in here and let's say I wanted to buy these and I bought 3 of them up here. I don't put a stop in right away. See, I'm dead. Now I'd be dead wrong right here. I'm long, 3 or 4 at 34.75? I probably ain't going to get a scratch. I got to get out. My stop is right in there. Just hit it. So let's say I bought it up here. I want to buy it and be wrong. I don't right away put a sell stop in there. I have a mental stop. So you move these sell stops, and I'll have my arrow around the red because what do I have to do to get out of a long position? I have to sell it. What do I have to look for? Bids. What am I going to hover over? Bids. If I wanted to get out at 34 quarter, 34 half, that's where my arrow is. If it gets down there, I'm going to click. If I say the heck with it, I'll just scratch it. I go up there and I hit the bid up there. Get good at that functionality. You don't end up trading that way. When there's a lot of momentum trading, that's the order type of choice. Limit orders mostly to get out of a winner, but if you're wrong, market order to get out of a loser. And that's it. I want to cut this short. I'm going to stop recording right now. This is the end of this.